Welcome to the Deep Dive. Today we are plunging into, well, a really interesting framework for trying to understand what drives Bitcoin's price. It's presented almost like a hidden formula in the material you shared.
That's right. Yeah, we've been looking at an article and also a video excerpt that really digs into this specific view.
Okay.
And it's kind of built around this idea that there are these underlying forces, not just the day-to-day news or price action, that are the real movers.
Okay, let's unpack this then.
Yeah.
Our mission here in this deep dive is to really get a handle on this proposed system because it challenges that common idea that Bitcoin just moves randomly or, purely reacts to headlines.
Exactly.
The source seems to suggest there are predictable drivers.
Yeah.
Behind the big cycles, at least.
Yeah, and the surprising thing, or what the source really highlights, isn't that you could predict the exact price on any given Tuesday,
Right.
But that the system of cycles itself is, well, arguably predictable based on just a few key factors.
Yeah.
It's more about understanding the rhythm, the overall flow, not hitting every single precise note perfectly.
Okay. So what are these big foundational forces that the source material points to? It feels like they boil it down to three main ones.
Yeah, they do. The source identifies them as, first, global liquidity. Second, the amount of leverage washing around in the system. And third, critically, human emotion. The collective psychology of the market. That big swing between pleasure, greed, fear, and, pain.
Global liquidity. Okay, that makes a certain amount of sense intuitively. I mean, when there's just more money sloshing around looking for a home globally, some of it's probably going to find its way into riskier stuff like Bitcoin.
Sure.
But how does the source specifically connect that liquidity to Bitcoin? Is it just a general correlation, like more money, price go up? Or is there more to it?
Well, it goes a bit deeper than just more money helps. The source suggests looking at specific indicators of systemic liquidity. Things like central bank balance sheets, or just the general availability of credit around the world.
Okay.
The argument is that this kind of creates the fertile ground. As this liquidity increases, it doesn't necessarily just directly buy Bitcoin itself, not always. Often, it first fuels the next big driver, leverage.
Leverage, right. So borrowing money, using derivatives, basically ways to amplify your bets, both gains and losses.
Exactly.
How does the source describe this building up specifically in the Bitcoin market, and how does it tie back to that liquidity point?
Think of it like this. Loads of liquidity makes borrowing cheaper and generally encourages people to take more risks.
Okay.
So the source suggests this ease of credit leads to more and more leverage being piled on across the system. You see it in futures markets, on lending platforms, even institutions get involved. It's like kindling building up slowly.
Right.
And the source might point to metrics like, say, open interest in futures, or maybe funding rates, as signs that this leverage is accumulating. And that leverage then makes price moves much, much bigger, amplifies them.
Got it. So global liquidity creates the environment, sort of primes the pump, which then encourages leverage, which then makes the whole market much more sensitive to swings. And that's where the third piece comes in, the human emotion part.
Precisely, yeah. As liquidity and leverage build and, prices start moving up nicely, well, that's when greed and maybe pleasure take the wheel. People become less worried about risk. They start chasing those returns. And this emotional state, it actually encourages even more leverage and pulls in more liquidity chasing the trend.
The feedback loop.
Totally. And then conversely, when the cycle inevitably turns, fear and pain take over. That drives panic selling, forces people to deleverage, often made way worse by all that leverage that was built up before. Yeah. So the source suggests these three things: liquidity, leverage, emotion. They don't just exist separately. They interact. They're locked in this cyclical feedback loop. It's quieter during accumulation phases, when things are calmer.
Right.
Then it gets explosive during the expansion and pretty painful during the contraction.
So the core idea from the source then is that these exact same forces interacting in this specific way, liquidity setting the stage, leverage amplifying things, emotion driving the extremes, this pattern has quietly driven every single major Bitcoin boom and bust cycle. That's quite a claim.
It is a strong claim, yeah.
What's their reasoning, or the evidence they point to for it applying across all the cycles?
Well, the argument presented is basically, if you look back historically, look at the environment around past big cycles, like, say, 2017 or the 2020-2021 run. You tend to see periods where global liquidity was expanding significantly.
Yeah.
Then That was followed by really noticeable buildups of leverage within the crypto ecosystem itself. And those phases culminated in, that peak emotional euphoria. And then, inevitably, the crash, which was fueled by fear and a lot of forced deleveraging, the source basically posits that this pattern repeats because the underlying drivers, the human psychology and the systemic financial stuff, they fundamentally stay the same.
Okay. So if these forces create these, let's say, broadly predictable cycles, then the main takeaway isn't trying to nail the exact top or bottom price, right? The source seems pretty strong on advising against that.
Oh, definitely.
It's more about positioning yourself ahead of the curve, understanding where you might be in the cycle.
Exactly that. The source really emphasizes stopping that reactive approach. Don't get constantly whipped around by the daily price noise. Don't burn yourself out trying to perfectly time the absolute peak or the absolute trough.
Easier said than done, maybe.
Well, yeah, but the idea is understand where you likely are in the cycle, driven by these underlying forces, and then position yourself in anticipation of what might come next. They use an analogy in the source like the market is a river. You can't really fight the current. You need to figure out how to navigate with it.
Okay, navigating the river. That raises the practical question, though. How do you actually do that positioning based on this understanding? The source mentions specific strategies like tiered entries and conviction-weighted allocations. What does that mean in practice?
Right. So tiered entries basically means you don't just dump all your capital in at once.
Yeah.
You scale into your positions over time and potentially over different price points. But crucially, based on this framework, you wouldn't just buy because, say, the price dipped 10%. You start layering in your buys as the underlying forces signal a potential shift towards an accumulation phase. So maybe you'd increase your buying activity as you see signs that global liquidity is expanding again, or that a lot of the previous leverage has been flushed out of the system. The source specifically mentions planning to buy more on dips. If those dips happen when the framework signals suggest it's actually an opportune period for entry, not just a random price drop.
Gotcha. And the other one, conviction-weighted allocations.
Yeah.
How does that fit in with liquidity, leverage, and emotion?
Yeah, so that's about adjusting the size of your positions or your tiers based on how strongly the signals from the framework seem to align. How much opportunity does it suggest relative to the risk?
Okay.
So, for example, if global liquidity looks like it's expanding, leverage seems to have been reset after a washout, and sentiment is still quite fearful or apathetic, which often signals a potential accumulation zone, then your conviction might be higher.
Right.
And that could lead you to plan for a slightly larger allocation within your tiered entry strategy for that period. Conversely, if you see leverage absolutely peaking, everyone's euphoric, number go up, is everywhere.
Peak mania.
Exactly. Then your conviction in adding significant new capital might be quite low, right? So that might lead to smaller planned allocations, or maybe none at all for a while. It's about using the framework's signals, those deeper drivers, to inform how much risk you're comfortable taking at different points in the cycle.
So it's really a strategy driven by trying to observe these sort of deeper systemic forces in the market's overall psychology rather than just staring at a price chart and making a guess.
Pretty much, yeah. That's the core idea.
And the source also mentions, I think, that they believe the market might be entering a new regime right now based on this framework. What kind of signals are they potentially looking at that would suggest such a shift?
Yeah, that's where you try to connect the theory to what's happening now.
Yeah.
The source implies they're seeing shifts or potential shifts in those key drivers we talked about.
Okay.
Now, they don't give like a minute-by-minute checklist, obviously, but the framework itself suggests you'd be looking for signs like maybe central bank policy shifts that indicate changes in future liquidity conditions, or observed decreases or resets in that systemic leverage. Perhaps you see that through big liquidation events or major corrections in the derivatives markets.
Right, the system cleansing itself, kind of.
Sort of, yeah. And also, you look for that transition in market sentiment, moving away from widespread fear or just apathy towards maybe renewed interest.
You're going to think of this as like an emotional heartbeat. Because again, like if I'm sitting on a lot of profit, I'm probably going to take some profits. Maybe I'll pay off my house or buy something new, right? Or if I'm at a loss, I want to hold it. So it plays with my emotions. And so it sort of gives us that leading indicator of what the market may do. Okay, so the question is, if we combine all these, where are we now? I've kind of already given that away. If we add the GRS, the DRS, and the NPRS together, where are we? But what I haven't given away is, based off historical returns, where do we go from here? If we look at past market cycles that we've seen this, what could potentially happen from here on out? Let's take a look. All right, so if we go back and we put all these together, again, and combine them, what we can see is we're right here in about 2.6, 2.7. So that means we need to go a lot higher here for this to come up a lot higher here. We're already up quite a bit off the bottom. Doesn't mean we're at the top. You have to understand market cycles, right? So we're above, right? We're at new all-time highs, but at the midpoint of the cycle, not at the top of the cycle like we were last time we were there. So based off of the combined score, we can see we're in about a neutral market. Again, we're not anywhere near caution. We're not at 4, we're not at 5, and that sort of tells us that we have a long way to go. Now, based off of past performance, which again is no guarantee of future performance, but based off of past performance, when we've seen these levels before, what has Bitcoin done? Now, if we look at each of these indicators on its own, they all have different data. But if we combine the three, we get something different. Okay, so network profitability, risk score, NPRS performance. And basically, right now, we're sort of in this neutral range. We're a little bit lower than neutral, but let's just call it neutral for this exercise. Okay, so what this says about almost 60% of the time this has worked. In 30 days, we'll see 11%, 90 days, a 45%, 180 days, a 96% return. Double. Okay. It's not guaranteed, 60%. So that means it's a base case. So what we want to do is we're always looking at the odds. Again, poor mentality thinks about how much money can I make and they YOLO in. But smart money always makes structured, strategic bets. How much should I allocate? Well, it depends on what my odds are. If I have a 90% chance of winning the bet, I'm going to bet more. If I have a 10% chance, 10% odds of winning the bet, I'm going to bet a very little bit, obviously, right? So we want to understand the odds and what the probabilities are. And based off of where we're at right now, we have a long way to go. All right, we have a long way to go. Now, understanding this gives us new tools. But how do we use all this? How do we use all this? Again, so the first thing is this is not a crystal ball. This doesn't predict the future. This doesn't tell us exactly what Bitcoin's price is going to be on what date and when it's going to turn around. It doesn't tell us if there's another big dip coming that you should wait to buy the dip. What it does tell us is if it's expensive or if it's cheap. It does tell us if we're starting to get overbought or oversold. It does tell us maybe when we should be pressing in harder because the odds are with us, or we might want to pull back a little bit because the odds are against us. Now, I would strongly advise against trying to time this and sell out and buy back in. Because what happens, let's take 2017, for example. In 2017, Bitcoin ran from 1,000 to 20,000 in 1 year, okay? From 1,000 to 20,000, 20 times. It's pretty amazing. But if you were looking at these indicators around, I don't know, it was around 4,000 to 5,000, it started flashing. That was the top of the market. It was overbought. It had gone up 4 or 5 times. It's amazing. If you're a traditional investor, this is the best returns you've ever seen in your life. And so the indicators were showing it was very expensive. And so if you were following that and trying to time the market, you would have sold out, you would have cashed in. And you would have missed the run from 4 or 5 grand up to 20 grand. Now, what happened is, of course, it crashed all the way back down. And you were going to try to time the bottom. But of course, nobody wants to catch a falling knife, so you're waiting for something to turn, some sentiment to turn, the charts to turn to tell you when to start buying. But Bitcoin moves so violently that really quickly it moved higher, and now you're buying back in at 6 or 7K. So if you tried to sell out at 4 or 5, you missed this, and then you bought in at 6 or 7, you actually got behind. Now, if you're like, whatever your circumstances, maybe you're older, you're on a fixed income, you don't have a long time frame, hey, maybe the 4 or 5 times on your money was amazing, it was the best return you've ever had.
But crucially, before you hit that widespread euphoria again, the movement in these underlying forces, according to the source's perspective, is what might signal a potential transition phase is underway.
And by recognizing those signals, or trying to, the idea is you can start implementing those strategies, the tiered entries, the conviction waiting before the price action fully catches up, positioning yourself ahead of the main crowd rather than just reacting when it's already obvious.
That's exactly the goal presented. It's based on the idea that the price you see is really a result or an effect of these deeper forces and the collective emotion. Price isn't the driver itself in this view. So by focusing on those underlying drivers, you're trying to align your strategy with the bigger picture cycle that the source describes.
Okay, so let's try and wrap this up then. We've taken a pretty deep dive into the specific framework for understanding Bitcoin's price dynamics, the one presented in the source material we looked at.
Yeah, we've seen how the source suggests it's fundamentally driven by this interplay between global liquidity, the amount of systemic leverage, and, well, the powerful cyclical nature of human emotion, fear and greed, pleasure and pain.
And the core takeaway really isn't about trying to predict the exact future price, which seems like a fool's errand according to this source.
Definitely not.
It's more about using this understanding of the cycle drivers to try and position yourself strategically ahead of the big market shifts, implementing methods like tiered entries and those conviction-weighted allocations guided by the signals from this framework, instead of just reacting to the latest price swing or trying to perfectly time the tops and bottoms.
Exactly. And that leaves us with a pretty interesting thought, I think. If market cycles really are driven by these identifiable forces and these predictable, almost programmed human emotional swings like this source suggests, right, what does that truly imply about the role of disciplined, pre-planned positioning versus that constant, often frustrating attempt at precise prediction in investing? And maybe even more fundamentally, how genuinely challenging is it for us as humans to actually override our own emotional responses when we're navigating markets that might be fundamentally driven by collective fear and greed?
That's definitely something to chew on. How much is discipline versus prediction, and can we really detach? Food for thought as you look at the markets yourself.